So we have had a really strong rally. It does look sticky, but it hasn't changed what the Fed has to do. It hasn't changed where inflation will still be, at the end of the year and for most of next year, which is definitively not at the Fed's target of 2.5% likely. And so I think there's going to be continued volatility. You're going to still have to be choosy. We still have a preference for high quality in this kind of environment because, the worst of what this could have been might be behind us or might be priced out of the market. But I still think it's a challenging environment. Very challenging macro environment, very challenging for these operators of companies, as you're talking about. And so I think don't get complacent. The same advice to the Fed is the same advice that investors should be heeding right now.
Hello out there, and welcome to another episode of the Financial and Crypto Space Analysis. Today, we would be taking a listen to what Lyn Alden said in her recent interview regarding the possible risk regulations and health of the macroeconomy would have on digital assets. She would be talking more extensively on the dollar and the digital dollar in the form of stable coins. Are they as reliable as we presume? Why is the digital dollar doing so well against other currencies, and what is the dollar performance dependable? We would be taking a look at the global forces dictating the dollar value and what we can expect even now that the buzz is all about the moves of the US government to stabilize the economy. If you're new here, don't forget to subscribe and turn on the notification bell so you never miss out on any of our updates on the economy and the crypto market.
Where are we right now in terms of your framework for digital assets?
Well, so I think the broader macro view right now that affects digital assets is that we have, kind of risk off conditions broadly. Lately we've had a little bit of a risk on uptick within that, but in general we've been on a risk off slant, which makes sense because we have declining PMIs, and so basically we have economic deceleration in most parts of the world, across Europe, across North America, many other markets. We have a strengthening dollar, falling liquidity, and if you map Bitcoin and then the various other projects that ebb and flow because it's all kind of correlated. It tends to follow the PMI cycle pretty closely. And if you want to be even more specific, I would say it slightly front runs PMI because it follows liquidity pretty closely, and liquidity tends to be a little bit ahead of PMI. And so generally speaking, you see Bitcoin kind of top around the same time that PMI tends to top. And then it usually bottoms a little bit before PMI. But of course, we don't have gigantic sample sizes for these observations. We're talking a little bit over a decade of history here. And so the short answer is that from a broad macro perspective, everything in the space is treated like a risk-on asset.
Right.
And so, they're volatile, especially outside of Bitcoin, you're getting into pretty speculative territory. But even Bitcoin, even the maxis might view it as a risk-off kind of counterparty free asset. But just in terms of where liquidity goes, the bigger ecosystem treats it like a risk-on asset, and just in terms of price. And so I say that's where we are right now. We're kind of obviously in a pretty strong bear market. I think that there are signs that this, we could have had the bottom in place for Bitcoin. But I think the next 6 to 12 months are still pretty fraught with risk until we see a more decisive upturn in things like PMI. And you can also track the same sort of cycle by looking at, say, the copper to gold ratio. If you kind of overlay that on with PMIs, you get the same kind of looking pattern. Basically, once you see these risk on conditions improve, that should be more of the green light for this asset. But in the meantime, it's I think we're in kind of a pretty tricky market.
Lyn Alden says we are still in what she calls a risk-off slant, despite the past month bringing some relief from the downward dive of assets and securities so far this year. What makes a season a risk-off season? This is when investors taking action to curtail losses in investment, moving their capital from stocks and now cryptocurrencies too, and moving to buy more stable currencies such as bonds, treasury bills, gold, and even keeping their funds in fiat considered to be strong. It is interesting to note that expert investors are actually not rushing into investing, despite of the respite in the assets arena. The market has enjoyed some steady resurgence, but many experts still believe we are still in a risk-off season. Lyn says we cannot divorce the performance of Bitcoin from the macro market because we look at market performance indices such as the PMI, that's the Purchasing Managers Index. This index tracks the direction of the manufacturing sector, which generally reveals the health of the economy. Taking a look at the charts, the correlation is astonishing. Just as Lyn revealed, the two indexes correspond to each other over time. This reveals that a rally in Bitcoin prices without a rally in the PMI could be a short-lived one. Until there's a significant rise in the PMI, it's safe to consider most investments as high risk. While you can do little to help the performance of the economy, you can do a lot to help the performance of this video by clicking the like button. Why don't you do that and help this video move up the recommendation index? Back to the interview.
So that's the unit of account that many of us are using when we're measuring the price of assets. And so if the dollar is strengthening, at least on a relative basis compared to many other fiat currencies, when you translate things back into dollars, it's a challenging comparison. In addition, it affects global economic growth because, for example, the marginal growth in the world is in emerging markets. That's where the majority of population is. That's where we have less GDP per capita. So it's easier to get the marginal growth from those economies. You generally have better demographics in most of those countries, unless you look at specifically countries like China that are kind of still quasi emerging markets, or at least classified as such. But when you look at traditional emerging markets, like a lot of Latin American countries or a lot of countries in Southeast Asia, you have dollar-denominated debts. That's one of the key differences between a developed market and an emerging market is that an emerging market, there's a decent percentage of its liabilities, either government or corporate or both, that are denominated in currencies that they can't print, that are either dollars or euros, basically foreign hard currencies. And so when they have an environment where those currencies are strengthening rapidly compared to their local currency or compared to whatever currency they're getting their cash flows in, they're getting squeezed on the liability side. It's like if you took out a mortgage in gold or Swiss francs, something that's harder than maybe the dollar at that current time, unless you have a spike in the value of that mortgage, that's not great. And so that's essentially what you see happen to emerging markets every time the dollar strengthens.
Considering that investing in the stock market or cryptocurrencies is still risky due to the feeble economy, it is smart to look at securing capital in stable securities, such as treasury bills and currencies with low volatility. While the aim here is not to have huge returns, it mitigates against devaluation. From a global perspective, the dollar seems to be one of the safest currencies to save money. Lyn reveals the strength of the dollar is strongly tied to the performance of growing economies, because a lot of these emerging economies have liabilities that are backed by the dollar. Many of these countries have debts in US dollars, and when their economies fail, they only have control over their local currency, leaving the dollar stronger than the local currency of the indebted country. Let's learn more about what Lyn has to say about this.
I think we're entering a more polar currency world where, especially throughout Eurasia, you're going to see just kind of changing reserve practices, kind of a diversification of payment channels. And I think we're headed that way before the war, and then the war just kind of kicked it up a notch, accelerated that whole thing. So that's been one of my theses. But at the same time, you have a slight offset to that in the sense that the people, regardless of what their central bank's doing, they can go out and buy dollars now. And so basically you've increased the total addressable market for dollars or specifically you've allowed a larger share of the total addressable market to actually access them in a way that makes sense to them. I do think this has implications. It's on the macro scale, it's still a relatively small market. I mean, you're talking over 100 billion, so it's not a small market. It's becoming a meaningful market. But if that becomes many hundreds of billions of dollars or $1 trillion, that obviously has pretty strong implications for the dollar. And I think we're in an environment where, I mean, like an Argentinian explained it to me. He's like, if I want currency for the next month, I hold it in local currency. If I want some savings for the next several months or a year or more, I'll use some stable coins. And if I want super long-term savings, I'll put some into Bitcoin, which is obviously more volatile and has more appreciation potential. And I think that's kind of the environment that we're in for a period of time, subject to what happens with regulators. Because like I said before, those stablecoin providers are, centralized, and they're therefore subject to regulations. They can blacklist accounts. They basically have to comply, with the major powers, international laws.
The natural response to failing currencies is for people to move to more stable currencies, and in this case, the United States dollar. But this comes with its own risks, especially in most of the developing countries, where the government could come up with regulations that would affect bank transactions involving foreign currencies, hence the accounts holding these currencies in these countries. To avoid this risk, stable coins become the best option, as it provides an avenue to hold the dollar in a digital form that is unreachable to locals. Does this mean stable coins are 100% safe? Lyn reminds us that real stable coins that are backed by the dollar are under centralized management that abide by the regulations of the United States. This means they are not 100% immune to risks that come with regulations. Lyn still believes Bitcoin is the best investment when looking long-term, but stable coins come highly recommended for short-term holding as the dollar continues strong in the global arena. We would love to hear your opinion on what Lyn Alden said in this interview. Leave a comment below. Thanks for watching.